Welcome to another video. In this video we will explore the concept of investment banking. We will look at what services investment banks offer, what investment bankers do, and how investment banks make profit. Let us begin. In simple terms, investment banks offer financial advice to their clients doing business in the capital market. What is the capital market? The capital market provides an avenue for companies to raise capital through the sale of equities or bonds, and the investment banks act as the intermediaries between the investors, who want to invest their money in profitable ventures, and companies, who require capital to run their businesses. So, what services do investment banks offer? Firstly, investment banks are a great resource for startups and companies in their early stage of growth because they can offer the best financial advice, which would help these category of companies structure their long-term financial goals and position themselves for entry into the public market. Secondly, investment banks help companies raise capital by issuing securities to the public through a process called underwriting. Underwriting involves raising capital through the sale of stocks or bonds to investors. So, how does an investment bank underwrite for companies? An investment bank acts as an underwriter for a company in two ways. 1. The investment bank agrees to buy all of the company's shares to resell at a premium and assumes full financial responsibility for any unsold shares. This means that the company would buy all of Company A's shares at $2 per share and resell at $5 per share. And, if it does not succeed in selling all of Company A's shares, it would still pay Company A the full amount for all the shares. This provides immediate capital for the business and insulates the company from risk. The second way the investment bank acts as an underwriter is by agreeing to sell the company's shares at an agreed price, but in this instance, the investment bank is at liberty to return any unsold shares to the company without any financial liability. This means that if the investment bank agrees to sell 2,000 shares of Company B, but could only sell 1,000 shares, the investment bank is not liable to pay the company the price of the unsold 1,000 shares. Also, in this case, if the investment bank undertakes to sell all of Company B's shares as a lot but could not sell off all the shares as a lot, the transaction falls through and Company B would receive no payment from the investment bank. A third service that investment banks offer is that they provide advisory services to companies on mergers and acquisitions, M&A. Offering advice on mergers and acquisitions means that the investment bank helps companies identify, evaluate, and finalize on acquiring other companies and businesses. In offering this service, investment banks leverage their extensive networks and business acumen to find opportunities and negotiate deals on behalf of their clients. Transactions involving mergers and acquisitions usually has two sides of the bargain, the buy side and the sell side. On the buy side, we have a company wishing to acquire another company or a company that is offering itself for sale. In this case, the investment banks can provide company valuations that help determine the price at which the company may be sold. They can also offer advice on the value of the company being acquired as well as the most favorable way to structure the deal. On the sell side, we have a company being targeted for acquisition. Here, the investment bank can determine a reasonable asking price for the company and advise their client on favorable or unfavorable structures of the sale. Now that we've looked at the services offered by investment banks, let us examine what investment bankers do. Basically, an investment banker is a financial professional who works with an investment bank. Investment bankers facilitate large financial transactions like mergers and acquisitions. They prepare and submit detailed documentation on behalf of their clients to regulatory agencies like the Securities and Exchange Commission, SEC. They help their clients identify the risks associated with a particular project before the company takes further action on the project. Because they are experts in their field and aware of the prevalent investment trends, their advice is often important. The next point is, how do investment banks make profit? Investment banks make profit by charging a fee for their financial consultancy services. However, considering that investment banks primarily focus on underwriting and mergers and acquisition services, let us consider how they make money from these two services. Firstly, how do investment banks make money through underwriting? Investment banks make money through underwriting by offering the company's shares to the public through a process called initial public offering, IPO. In this case, the investment bank acting as an underwriter will buy all or much of a company's shares and subsequently sell these shares to the public at a markup. For example, suppose that BC Limited wants to go public. The owner of BC Limited would get in touch with an investment banker we can call Peter. Peter and BC Limited reach a bargain in which Peter, acting on behalf of his investment firm, agrees to buy 100,000 shares of BC Limited for the company's IPO at the price of $26 per share based on the recommendations of his analyst team. The investment bank would then go ahead to pay BC Limited the sum of $2.6 million for the 100,000 shares. On the day of the IPO, the investment bank sell the shares to the public at a higher price than it paid to make a profit. Experienced analysts at the investment bank use their expertise to price the stock accurately. Otherwise, an investment banker can lose money on the deal if they have overvalued the shares. This is why investment bankers and their firms take on a high level of risk during an IPO. Following the above example, if the bank's analyst has overvalued the shares, resulting in low demand for the shares, the firm might not be able to sell all the shares at the estimated price and would be forced to reduce the price in order to sell out. Thus, even though BC Limited would still receive $2.6 million, the investment firm could incur a loss on the sale. Alternatively, the investment bank could sell the shares on behalf of BC Limited and earn a commission on each share. Now, let us look at how investment banks make money through mergers and acquisitions. Mergers and acquisitions usually involve two investment banks working on the buy side and sell side of the transaction. At the inception of the transaction, both companies may not be certain about the right price and possible benefits or losses of the deal. This would then require that they contact their investment bankers. These investment bankers would then go through the process of due diligence to ascertain the value of the company and prepare necessary documents and advice on the right timing of the deal. In this transaction, both investment banks will make money on commission, and the bigger the deal size, the higher the commission the investment bank will earn. I hope you've understood the concept of investment banking and how it works. See you at the next video.
Thanks for watching. Please like, comment, share and subscribe. We value your support.